Life happens, things get tight, but what actually happens if you miss a mortgage payment? Today, we're breaking down the timeline, the consequences, and the options you have long before foreclosure is on the table. Welcome back, guys, to another episode of Closing the Deal. I am one of your hosts, Zach Dixon, and sitting across from me on my screen today is my co-host, Sam Enright. What is going on today, Sam? How are you?
What's going on, man? I'm doing splendidly. How are you?
Oh, fantastic. Cannot complain. Cannot complain. We're about a week out from Thanksgiving, one of my favorite holidays of the year, which also comes with the Ohio State-Michigan game on Saturday as well. I really just enjoy this upcoming week that we have each and every year. So definitely got a little bit of juice today for sure.
Yeah, absolutely. It's always a great time of the year. I second that with you. I love Thanksgiving. It's probably one of, if not my favorite holiday. Maybe 4th of July could sneak its way in there. I do love me some 4th of July. So, but yeah, good food, good family, good football. You know what? You really can't complain. You know when kind of taking over some Lion fandom. You know they always get to play on Thanksgiving, so you get to watch that game and. So yeah, I'm definitely looking forward to it this year.
Most definitely an underrated holiday, I think. People don't really think about it at the top, in my opinion. Obviously, the thought automatically goes to like Christmas and New Year's, stuff like that. But Thanksgiving is a very, very underrated holiday and time in general, in my opinion.
I agree. I mean, you got a lot of people out here there's a lot of people I feel like that kind of just skip over the holiday in general, right? Like you
Yeah.
drive by houses, people already got Christmas lights up. You got people that got their trees out, you know what I'm saying? So I feel like in our family, like when growing up, like my mom was just always like, she loves Thanksgiving. So it was always like a hard stop, like, okay, we're not touching a tree until after the holiday, until after Thanksgiving. Give Thanksgiving its proper celebration, right? And then kind of going. I know she's actually going down to Florida to have Thanksgiving, and she's hosting like this tour of homes this year for Christmas. So she's way ahead of the ball game. She started decorating like a month ago because she's obviously coming down, and as soon as she gets back from Florida, she literally like the tour starts that day, so she has to have basically all of her Christmas stuff up beforehand. So, but yeah, usually a good rule of thumb in our house growing up was always like, yeah, we're not doing that until we give Thanksgiving the proper celebration it deserves.
Couldn't agree more. That is also the rule we've established in our new house as well. Cameron's been
Yeah.
trying to throw that tree up the last couple of weeks. I'm like, no, we gotta wait just a little bit longer, just a little bit longer.
Oh yeah, for sure, man.
So what's on the docket for today? What's our episode topic? What do we have for the listeners?
Yeah, today we're going to be talking about what happens when you miss a mortgage payment. This is a pretty interesting one, especially like I feel like in today's overall market. I was just reading some information about like Tampa, Florida, and how many foreclosures that they've had over the last, I don't know, 6 months, or I guess maybe a year. And it's astounding, and obviously with where everything was at in 2020, 2021, low interest rates, spiking home prices. And now we've gotten into a high interest rate market, and those home prices have sustained, if not gone up even more. Now we're in a position where yeah, some people might be over leveraged on their house, right? And, what happens if they begin missing payments? What happens if they can't afford it? And then there's obviously the whole other spectrum. What happens if you sustain an injury on the job and you can't work? What happens if you lose your job? What happens if something serious in life, medical bills, those sort of things come across, and you find yourself in a tough position, right? So what are the options, and what actually happens when you miss a mortgage payment? So just kind of breaking that down across all the spectrums of what could potentially, I guess, happen that would cause you to miss one, and also how to kind of combat that, right? Because we talked about it in previous episodes. what is the last thing the bank wants to do? The last thing the bank wants to do is come back and take your home from you. They are not in the business of foreclosures. They're not in the business of holding real estate and trying to sell it. They ultimately want you to make your mortgage payment for a very, very long time and collect the interest off of that. And that's where they want to make their money. So they are willing to work with you. And there are some options and things that you can do, obviously, before it ultimately leads to that final destination of what foreclosure, right? Before the bank takes it back. So just kind of given an idea and an overview of that timeline, and kind of the different steps that are available to you at that time.
For sure, because I think, home buyers and non-home buyers alike, we ultimately they know what the last step is of foreclosure, when you miss that mortgage payment. But there is a large chunk of, stuff that happens in that 30, 45, 60 day time period, that is a little bit different than maybe somebody has experienced on the rental side versus on the homeownership side. It's a little bit more have a little bit more leeway on the homeownership side, as we will get to, I think, in this episode, than on the rental side. And I think that maybe, might be the only experience of some of our listeners, some of the home buyers out there, is just maybe going through that process of when they missed a rent payment, and how that kind of works. So going to explain, the differences between that as well. And just, like you said, just go through the process as a whole and kind of start to finish.
Yeah, for sure. Well, I mean, that kind of takes us into the first one here. First kind of timeline. So we're going to break this down for you guys over like a 30-day period, 60-day period, 90-day period, 120-day period, that sort of thing. So this is one that I think is really important, because this is the same way with credit cards and credit in general, is what happens immediately, right? So we're talking about the 0 to 30-day window here before you actually reach that 30th day. So let's just call it 0 to 29, right? And so with every mortgage, your payment is due on the first of the month, and you actually receive a 15-day grace period for that payment. So you could technically make your mortgage payment anytime from the 1st until the 15th before you're going to incur any late fees. So obviously, you paid on the 8th, you paid on the 9th, you paid on the 13th, whatever the case may be. Business is normal, business as usual. You make your payment, it's due on the 1st, you make it before the 15-day grace period is over. So after that 15th day, right, now you're going to be getting into your late payment period, or I guess a late fee, so to say. So to kind of segue off of that for a second, a lot of people don't realize, and when they think about making late payments, like I've heard clients say, oh my gosh, I was late on my credit card, 2 months ago and this, and then we'll pull their credit and there's nothing on there, right? And so it's like, they're a little confused. Like, what do you mean? Like, I know that I made that late. I had a late fee on my credit. And I say, well, okay, when did you make the payment? Oh, I made it 15 days past the due date. Well, by credit report standards, you are never actually truly late. They're not going to report a late payment until you've actually reached that 30-day mark, right? So if you were to pull a credit report, you will see 30 days late, 60 days late, 90 days late, and then obviously after that would be pretty much default, when you're going to basically lose the debt, right? Or I guess lose the account. And so inside of that period, you are going to have late fees. So if you miss your credit card payment by 2 days, yes, the credit card company is going to charge you a late fee for being late on that payment, right? But you're not going to get you're not necessarily going to get the derogatory remark on your credit by just being 2 days late. So same thing with mortgage, right? Let's say you make your payment on the 16th, or you make it on the 20th. You're still technically within that first 30-day window. You are going to incur a late fee from your mortgage company for missing the grace period time window of your payment. However, you're not actually going to get any of the negative benefits on the credit report yet, because you have not reached that 30-day milestone. So we always tell people, like, obviously life happens. Things get in the way. We have emergencies come up, those sort of things. If you have to miss a payment, or if something goes wrong, obviously you have a little bit of a grace period there before you're going to notice the impacts on your credit, right? So trying to make that payment anywhere inside of the first 29 days is going to be largely beneficial to you, especially when it comes to the credit side of things, right? So you will have that late fee. Typically, I think it's going to be anywhere between 4 to 6%, just depending on, what has reflect or what you have agreed upon, or your late fee when it comes to the mortgage. So obviously not getting to that point is going to be largely beneficial for you as well in your pockets, because who wants to make an extra 4%, 6% payment on their mortgage? You know what I mean? So making sure that you have that stuff taken care of ahead of time is going to be huge. So most people don't know that. I feel like there is that little bit of grace period in there that you can kind of use and, leverage if you are in a pinch or you are in a bad situation and you need just a little bit of extra time. Just obviously do everything that you can to make sure that by day 29, your mortgage is caught up. Obviously, yes, I know that if you're catching it up on day 29, that and I know that within the next day, you're going to owe another payment, and you're going to have another, 15-day grace period. But, obviously what we want to do, what you would hope to do, is avoid the snowball effect, right? And you don't want that to then compound, and then you miss a payment here, and then it just, becomes this thing over time. So, really trying your best to kind of reach into that window and make sure that you get it taken care of is largely beneficial.
Absolutely, absolutely, and I think that that's honestly a benefit that we don't really talk about with homeownership very often. That it's kind of underrated in my opinion, because when you think about it from the rental side, if you go 15 days without making your rent payment, you're probably you are definitely getting a late fee just like you would on the mortgage side after that 15 days. B, you probably already have a 3-day eviction notice on your door for non-payment of rent at that 15-day period. And C, you more than likely already have an eviction proceeding filed against you as well at that 15-day period. So ultimately, it's a very much a benefit to homeownership. You just have extra time to be able to get that together and make that payment. Ultimately, when you're a renter, that owner of the property has a mortgage payment for himself, and so he's in this exact time frame for his mortgage payment, and so that's why he's trying to collect his rent payment from you to be able to make that mortgage payment within that 15-day grace period. And so obviously that just is not something that really happens on the rental side. And so I think is a very big benefit to homeownership and gives you a little bit more flexibility as a whole, to get those things taken care of and, avoid penalties, avoid derogatory marks on your credit, because as we'll get into in the next segment and segments later on, they are very detrimental. They can be very detrimental for sure. So,
Yeah. Yeah, man. Late payments are not something you want to mess around with in any capacity, right? So there's nothing that will sink a credit score quicker than a late payment. So definitely want to be staying on top of that. And, like you said, that 15-day grace period really is like an kind of talked about characteristic of a mortgage, and kind of that benefit that you get a little bit. Obviously, you don't. I would still say, try to make the payment on the first, but obviously something comes up, it's great that, not a day later, on a credit card day later, you already got that late fee on there. You know what I'm saying? You're already paying that extra, whatever it is. Rent, same way. You miss a rent payment or you're off by a day or two. Like you said, you're getting blown up. Mortgage company's going to leave you alone for at least 15 days. So obviously gives you a little bit of time to get whatever's going on figured out. So yeah. All right, guys. Well, obviously we've knocked out that 0 to 29 day window. So, let's get into the 30-day late, right? So we already talked about this. So what happens if you reach day 30 and you have not made your mortgage payment? Obviously, we alluded to a little bit of the credit side of things, but what's going to happen from the mortgage standpoint as well? So obviously, once you reach day 30, your payment is officially going to be late. So you are going to now get that derogatory mark on your credit. Your mortgage company is going to report that to all three bureaus, TransUnion, Equifax, Experian, and you are going to notice a 30-day late payment on the credit, right? So the initial part of what's going to happen from a credit standpoint is your score is likely going to drop anywhere between 50 to 100 points. Obviously, that's a huge amount, right? Like we're talking about credit. Let's say you're a 700 borrower. You are now a $600. You're now a $600. You're now a 600 credit score borrower, right? If you're middle of the pack, 600s, like you've now sunk yourself down into a 500 credit score, right? So, late payments are the single biggest killer that we see consistently on credit, right? You can sustain a relatively good credit score even even overutilizing your credit balances, all of those things. But the thing that that no one can overcome is obviously going to be late payments. So the biggest thing when it comes to late payments is going to be time. Time is is your biggest asset, right? And who wants to wait 2, 3, 4 years? For the first 12 months, that late payment is still going to directly impact your credit score in a negative way. Once you reach month 12, it's no longer going to have a negative impact, but it is still going to be on there, and the repercussions of what it has done are not going away immediately, right? And so you have to wait that time period out. So I think it's really important that we obviously really harp on that part, right? You know, maybe not everybody in the world is big on credit, but ultimately there's a large part of our world in our country that runs on credit. If you want to borrow money for a car, you want to borrow money for a house, you want to borrow money on credit cards, you want to borrow student loans, you want to take a personal loan, an unsecured or a secured, all these different things. Like, in order to borrow money, in most cases, unless you have thousands of dollars on hand, you're going to need to, have credit, right? And so, putting yourself in that situation and having to work through that for the next 2, 3, 4, 5 years of your life is not going to be easy. And it's something that ultimately can be avoidable, right? And so that's where we, talk about loans becoming delinquent and what we do. And so, typically when you go 30 days late, you're going to receive some correspondence from your mortgage company, and they're going to reach out. I feel like this is a really great time to begin having those conversations with them. If you feel that this is going to be something that's going to snowball, if you are in a really bad position and you don't see an end in sight, then this is the point in time where, again, we need to start having open lines of communication with the mortgage company, right? Because, again, what did we talk about in the very first part of this? The last thing they want to do is take the home from you and then go back to market, lose money, and all of these things, especially when you're talking about, one, the foreclosure process it's not um fast by any means, right? And it's already going to be 120 days before they're actually going to go through with the entire foreclosure process, which we will obviously talk about. But avoiding that at all costs is obviously the best case scenario for you, right? So at 30 days, we need to be hitting the panic button a little bit, but it's not, we're not past the point of like, we can't get out of this, but it is time to start probably having some really tough conversations inward and saying, okay, what is going on here? Why am I late? How can I fix this? Is this budgeting problems? Is this me problems? Am I spending too much money on these things, or did you overextend yourself? That is one thing that we've talked about in previous episodes is, yes, on paper, we look at debt to income ratio. So we look at what is reporting on your credit. But again, you only know the true numbers of what it is that you're spending every month when it comes to insurance bills, groceries, gas, things for your children, things for you personally. Like, the true budget numbers of what you need. And so just because on paper, we can get the job done doesn't necessarily mean that that is going to fit your lifestyle. And so that's why it's almost important to have those conversations in the very beginning, right? When we first get started and deciding what is going to be, the best thing for you.
Yeah, I couldn't agree more, brother. You made some great points in there, honestly, about credit specifically. Some of those things that we need credit for, they sometimes they do happen on a whim. If you have an emergency and we have to, pull money out to fund this emergency or whatever it may be, some of those things they do happen on a whim. And so if you are stuck with a late payment that's going to sit on your credit for 2, 3, 4 years, that is going to be a problem. If down the road you run into a situation where on a whim we have to pull money out, we have to open a new credit account of some sort, and it just makes it tough. Ultimately, you're not gonna. It's not an easy road back from that, as you stated there. And so, guys, ultimately, we've talked about it so many times, just throughout the home buying process itself. But ultimately, just like you talked about there, it applies in this pre-foreclosure process as well. The solutions that can come from just communicating is unfathomable, honestly, for some people. I think that people don't communicate in hopes of things getting better, but it's completely the opposite, unfortunately. You have to communicate solve problems. And when you're in these situations, the more you communicate about the situation, the more information that you're able to provide, is ultimately going to help you set up a plan to get out of this problem and set you up for future success as well. And so if you're kind of holding these things inside, not communicating about it, just hoping that it'll take care of itself, more than likely will not be the case. Unfortunately, you want to make sure that, again, if you're in this situation, you're just being open, honest, and communicating as much as possible to get yourself in a better situation moving forward. Because obviously, going backwards, more than likely was not in the best situation. So we need to get that fixed and corrected going forward. And so we are good to go. So with that being said, at 30 days, your lender is going to start paying attention at that point. But again, if you communicate, it can still be fixed. Silence is the only thing that is going to be working against you in this situation.
Yeah, I think ultimately, man, that's a huge point. I mean, obviously touched on it. Retouched on it, but there's just communication, right? You deal with property management side of things. I mean, what is a tenant who reaches out and says, "Hey, man, I'm going through a real tough time right now. Like, I want to work with you. I want to get this figured out. I don't want eviction notices. I don't want to go through all these proceedings, but right now, like, I am struggling. So what can we do? What agreement can we come to, like, to make this work? I can do this much right now, and can I just, whatever the case may be, right? But a tenant, in my opinion, I'm not in property management, but I would think myself that a tenant that reaches out and just says, "Hey, man, look, this is the situation I'm in. What can you help me with? Here's what I'm willing to do." I don't want to just say, "Hey, dude, I'm not paying you at all. Like, can you just give me 3 months off?" But, what can you do to kind of help me get through this hard time? To me, even in the tenant world, it seems like that may still be easier to kind of work through than to go through the eviction process and then get somebody back in there. And then, how long is it going to be until you collect another rent payment on that property? You know what I mean? And so, even if it's less than what is normally agreed to, but you're going to recoup that down the road based on an agreement or whatever, to me, it seems like that would be more willing to work with. You'd be more willing to work with that person if that was the conversation that was being had, than just pure and utter silence. And yeah, pretty much, screw that guy. I'm not paying him. I got this going on, this, like, he's not going to be willing to work with me. So just forget about him and I'll let it go to the wayside. And it's like, again, I feel like even though the margins are a little tight, they're much tighter, I would say, on a rental property, right, than a mortgage. But I still feel like, as a landlord, I'm sure you're willing to work with people that are, kind of going through that tough time.
100% hit the nail on the head, honestly, just because it is, again, a process to get a new tenant in there. Ultimately, you're going to have to get the unit turned over. You're going to spend money doing that. You're going to put money into attorney fees. You're going to have all of this time and money and effort into a specific, tenant, and ultimately may not collect a dollar out of that. And so, yes, I wholeheartedly agree. Any scenario, communication is just going to be at the forefront of solving problems in any scenario. I can't harp on that enough. I can't stress it enough. Talking about the situation, talking about the problems is going to help you get through it a little bit easier, and that most definitely does apply on the rental side as well.
Yeah, for sure. Awesome. Well, obviously, continuing with our theme here, we're going to now 60 days late. So obviously now we are in a position where the problem has definitely compounded. You've now missed 2 mortgage payments back to back, and we are now into the 60-day mark. So obviously I feel like this now goes without saying, but you are going to receive an even further hit on your credit at this point, because now you have a 1 times 30 and now you have a 1 times 60. And so we are now in the position where we've missed two payments, and that's going to be a lot harder to come back from, right? So most typically, mortgage rates are a little different, but in most typical cases, you can get away with a 1 times 30 in the last 12 months. Sometimes you can even get away with a 1 times 30 on a mortgage in the last 12 months, if you have certain compensating factors to offset the credit impact, right? Once you get to 60 days, at that point, you are now 12 months removed from doing anything mortgage related at that point. So anytime we see a 60-day late, we see a 90-day late, anything above that, at that point, typically the underwriting system is going to give a refer eligible no matter what. And when you try to use a manual underwrite, you are going to run into the problems of having late payments on your credit. So, there's just, it doesn't work together. So if you needed to refinance to maybe get your payment lower, if you needed to sell that house and maybe buy a new one that's more inside your budget, you have now put yourself in a position where that's likely not going to be attainable for the next 12 months. So obviously stopping this before we get here is largely important. But again, obviously, most people don't want to be late on their payments. So I'm sure at this point, something serious is going on. And so it's also time to start talking about, getting back in touch with the lender and seeing, can we restructure this? Can we restructure the loan? What do we need to do to help you? Right. Because obviously becoming 60 days late is far more severe than that, just the 1 times 30 and being late once and catching it up and going there. Now we're talking in multiple months in a row of doing that. So yeah, it's just it's now become something that is going to severely be on the radar, right? And we really, really need to start taking a look at what our options are, because once we get to 90 and 120, now we're looking at, what, going into foreclosure at that point, right? So yeah, I don't really have much more to add at the 60-day mark, because obviously we're not done yet. We still got some time to go. But again, it really just follows all along the same lines of what we spoke about in the 30-day mark, right? Communication, communication, communication. It's probably, if you're not communicating, it's likely like, I'm sure most people, there's a sense of pride about it. I'm sure there's a sense of, I don't want to admit that this is what's happening. I don't want to admit that I'm having these issues. I know I can get myself out of it. I will get myself out of it. But once we've gone to 60 and again, starting maybe to even encroach on 90, like, we really need to have maybe some hard conversations, some hard truths with ourselves and say, obviously, whatever we're doing is not working, and we need to figure out how to get around that. Because obviously we'll get to it at the end of what foreclosure is going to mean for you from a home buying standpoint, what it's going to mean from a credit standpoint, all those things. Like, we're talking irreversible damages for a very long time.
For sure, for sure. So yeah, getting on to the next segment, and at 90, at this point, guys, we are starting to get to a real fork in the road. Ultimately, there is going to be two choices. Again, fix it or don't fix it and go on with the foreclosure. At that point, when you hit 90 days, your loan is going to enter serious delinquency. And at this point, pre-foreclosure processes are going to begin. And so again, guys, if you are at that fork in the road, it's still pre-foreclosure discussions at this point. You can get out of it, but again, you have to make a conscious choice to do so. Ultimately, the choice isn't going to be made for you. You have to make the choice to communicate and start to identify the issues that got you here in the first place. Ultimately, that is going to be the reason why you are here and how we can stop it moving forward. And so that is kind of what I'm getting to with this fork in the road. We have two choices. We can go this way or we can go this way. And ultimately, I guess you have that choice at the 30-day mark, at the 60-day mark, at the 90-day mark, and even at the 120. But after that, you've probably made your choice to continue down the foreclosure if you're at that point. And so I just want to reiterate, you have this choice throughout the entire process to get this fixed, to get to the root of the problem and get it taken care of moving forward. But ultimately, if you just keep kicking the can down the road, you're probably going to find yourself in a foreclosure, and that is ultimately what's going to happen down the road. So,
yeah, for sure. Excuse me. Sorry. So guys, I feel like this is a great segment. Obviously, we've been talking about communication, right? What does that look like? And I guess what options do you have at that point, right? So when you call your lender, you're going to obviously be open and honest with them. Hey guys, I'm struggling. Hey, you guys can see I've missed a payment. I've missed 2 payments, whatever the case. I missed 3 payments, here's where we're at, and here's what I'm trying to do, or what can we do to ultimately help mitigate this situation and figure out how a way around it, right? So if you call them, you can ask about things such as forbearance. You can ask about things such as payment deferral. You could look into a loan modification, things that may help ease the payment, ease those things that are, becoming pain points for you and becoming issues, right? And then, talking about a repayment plan to get back on track with what has been, gone behind, right? And so obviously, a lot of people probably don't think about those things. A lot of people probably think that once you start making the late payments to the bank, again, like, all right, yep, they just want this house. Like ultimately, like I've heard clients literally say, so we've done loans, and I feel like I've said this in the past, but we've had clients like, we're doing loans, we're asking for documentation, and then when we get to the point of like a document that they don't want to provide, they're like, I don't understand why I need all this. Like if I don't make my payments, the bank will just take the home from me. And it's like, guys, we're missing the point entirely. Like if you think that this business is based on the lender ultimately coming and taking your house, and that's where they make their money, and that's where all of this becomes, what they want, like that's so far from the truth, it's not even funny. So
They
that's,
would be a landlord, not a lender at that
yes,
point.
exactly. That it's actually the exact opposite of what they want. They will take your house because they're not going to let somebody live in a house for free that's not making their payments for 4 months. Yes, they will take it. They will foreclose on it. But like that is option Z, right? We have option all the way A to Z, and that's the final step, right? And so it's like, you guys, there's so much more options out there than you guys think. And so that's why, again, we've already said it at every single segment in this episode, but we'll say it again: communication, communication, communication. I think if all of you looked, or if you all thought about it, right, you guys would get to the point where you realize that most of problems in life are never solved, like ZD said, unless you're communicating, right? I mean, that's from A all the way from A to Z, right? Like no matter what the problem is, you got a problem with family members, communicate. You got a problem with your boss, you got a problem with your coworkers, communicate. Like nothing that just festers under the surface is ever going to be productive. So until you start having those conversations, like there's going to be no way out of it for you, and you're going to feel like there's no way out of it, right? You're going to feel like you're trapped and you're confined in this. Oh my gosh, I'm 60 days late. Oh my gosh, what's going to happen? I'm going to lose my house. All this is going on, and it could just be, hey man, just pick up the phone and have a conversation with them and see what they're willing to do to work with you, to make sure that you keep this house in your hands and you're not, moving your family or, whatever the case may be. Because ultimately, I feel like there's one thing that we all understand in life is that hardship is unavoidable for every single human being on planet Earth. It just is. So we're all going to have tough times. And I feel like, a lot of people are willing to work, with that.
Yeah, I couldn't agree more, honestly. And there, obviously, about 5 years ago, these things were being taken advantage of by homeowners, a lot through that beginning of the COVID process. We were seeing
Yeah.
forbearance a lot. We were seeing payment deferrals a lot, loan modifications, repayment plans, as all of those things were happening a lot throughout the COVID time period. And they helped a lot of people that were out of work at that point. Be able to continue to make those mortgage payments, and not get foreclosed on. But that's just one example of where they were widely used, but these things are available for you as a homeowner at any time. So again, just communicate, communicate, communicate. And the problem can be solved. It always can be solved 100%.
I think that right there, you just highlighted one of the best examples, like of the whole, like, well, the lender will just take my house. Like we were sitting on a national pandemic, and if all these lenders truly were in the business of having homes and foreclosing on them, why would they work with pretty much millions of Americans across the nation? Like, why wouldn't they just take all the homes and then they just own them for themselves, right?
Yeah.
And you know what I mean? Like, it's just that, again, that just goes to show you, like, being willing to work through all of that. Like, if they were truly in the business of just like, yeah, I'll just take the house, like, it's all good. Like, then they just would have owned millions of homes and called it a day, right? Because they had the biggest opportunity of their lifetime to collect on that if they really wanted to. And so it's just like, even in that, I know obviously it's more widespread and a lot of people were impacted. And so we tend to think, well, because a lot of people are impacted, that's only because there was just so many people that needed the help that they offered it. And that's not the case. They're obviously willing to work with you, the individual, on an individual basis as well, if you need it. Um, so guys, kind of getting into the last segment here, right? When we talk about long-term impacts and what happens once you reach 120 days of being late on your mortgage. Obviously, at this point, foreclosure proceedings have likely already started from the lender. They've already started to work on getting that process taken care of to obviously take the home back from you. From a credit standpoint, we've already talked about it. At this point, once you've reached 90, 120, this loan's going to go default. It's likely going to show as like a charge off account or something like that, or collection or some sort of negative, sort of trade line on your credit, right? That data is going to stay for 7 years. So, anytime a lender pulls your credit at that point, you're going to be looking at, that not going away for 7 years. The long-term impacts on your credit are likely going to be at this point probably high 400s, low 500 credit scores, and opening credit card accounts and paying off high utilization debt that that's not even going to make a dent at this point. That what I mean. So just that's just reality at that point. So once you obviously 12 months, those late payments are going to have that negative impact for 12 months. Once you reach the 12-month period, they'll no longer be having that negative impact. And so at that point, you can kind of start to rebuild. But again, you have that period of like, unless you're hiring somebody to go try to get this, account removed entirely from your credit, like it's going to be there for the next 7 years. So what does that mean about buying at this point, right? So let's say your home's foreclosed, you've moved out, 6 months has passed, you got a new job. You're making $50,000 more a year than you were before. Things are looking up. Things are looking great. You're like, hey, I'm in a much better situation. I'm in a more stable job position. I want to buy a home again. Well, for a foreclosure standpoint, I believe, I know conventional is at least 4 years before you'll be able to touch one of their products again. I actually think that most of them across the board are going to be 3 to 4 years at minimum before you're actually going to be able to buy. Obviously, that's going to be, hey, what does the credit look like at that point? How much has it rebuilt in that timeline? Those sort of things. But again, you're likely going to be a few years out. Now, in the grand scheme of life, is that a huge undertaking? If you're going to be on the earth for 85 years and you can't buy a house for 3, 4 years of that, obviously probably not going to be fully detrimental. So I guess there's obviously multiple ways to look at it, right? We want to avoid that, but ultimately it's not the end of the world. It's not like you'll never own another house again because you had one foreclosure in your youth years, in your 20s or early 30s or whatever the case may be. There is ways to come back from that. It's just obviously in that short term, the impact is going to be very, very large, and it may feel like a mountain that you have to climb and you don't even know how to begin. And so, obviously building back credit is tough. Credit is one of those things out there that is a very, very hard thing to build, and it's very hard to rebuild after kind of tearing it down. So but again, leaving you guys with this parting note that it's not all it's not all bad, right? The world's not coming to an end. There's obviously ways that we can come back from this and own homes again and obviously turn it around. We've worked with people that have had bankruptcies. We've worked with people that have had foreclosures in the past. And yes, you do have to wait quite a bit of time before that's going to be able to happen for you. But it is doable again down the road.
For sure, for sure. And I think the timeline that which you're kind of barred from purchasing by these financing types, it just kind of speaks volumes as to what we've been talking about this entire episode of, to the the solutions that are available to you in that 1 to 4 month time period. So if you chose to not have any of those solutions through the 30-day, 60-day, 90-day, 120-day period, that just kind of speaks volumes as to what moving forward, you had all of those options to right the problem, and you chose not to. And so unfortunately, the consequence of that is you're not going to be able to purchase a home for 3 to 4 years. And that is, ultimately why they're choosing that, because you had all of those options in front of you and you decided not to do those and not correct the problem at its source. And so I just think it speaks volumes as to why they have that period afterwards is because you had, options to correct the problem in the first place and chose not to.
Yeah. And just to get some clarity in there before we obviously wrap up. So conventional is actually a 7-year time period before you'll be able to purchase again after foreclosure. I was thinking bankruptcy. Um, and FHA, USDA are going to be 3 years, VA going to be 2 years. Sometimes if you can prove obviously extenuating circumstances or something major that was going on in your life that led to this, yes, sometimes they may shorten the period a little bit, but ultimately, generally, you're going to be in a 3 to 7 year window before purchasing again if you do happen to foreclose on a property. So it is one of those things that if it can be avoided, if you can avoid foreclosing, it is in your best interest to do so. Try to sell the home, try to do whatever you got to do to get out of there. You know, obviously, read the writing on the wall and get out when you can. So before it becomes too late, or, work through a solution with the lender or whatever you need to do. So yeah, guys, well, I mean, that kind of covers ultimately what's going to happen, from the different levels of, missing a payment and, what you guys can expect. So yeah, hopefully you guys found some value in this episode. Obviously, kind of some heavier stuff to talk about, right? Nobody wants to talk about missing mortgage payments. Obviously, we all go into getting a mortgage and we're, I'm pretty sure nobody's walking up and being like, yeah, I just want to make, late payments. Yeah, I don't want to pay my mortgage. You know what I mean? So it's not ultimately what, most of us intend for, but, it does happen from time to time. And, sometimes circumstances cannot be avoided. And so communicate, and, go from there. So, all right, y'all. Well, it does appear that my co-host is experiencing some technical difficulties on his end with his camera. So, I'm gonna go ahead and wrap this one up for us. So, hope you guys found some value. Really appreciate you guys tuning in. Obviously, to all of our episodes. We are nearing the end of the year here, which is pretty crazy. I mean, you guys are going to hear this. Oh gosh, what week of Thanksgiving? So, we got about 1 month left of the year, and really appreciate obviously everybody and all the support that we've gotten throughout the year, and excited to continue to bring you guys some more content as we, embark into 2026. So really appreciate you guys. We'll obviously touch base, and we'll see you guys on the next episode. See you.